Right now, capital is actively abandoning a stagnant Bitcoin and flooding into Ethereum. Retail traders observe this rotation and assume a bullish breakout is imminent. This chart reveals a sharp divergence. While volume is spiking, price action is hitting a hard ceiling. This mismatch suggests the inflow isn't driving price, it is being absorbed by defensive hedging. Why would smart money commit millions to a downside strike at the exact moment Ethereum is supposedly attracting all active market liquidity? Analyzing volume without the underlying options flow ensures retail traders provide the exit liquidity that institutional capital requires. To solve this, we're building a 5-layer institutional market scan from the ground up. Most traders view anomalous options flow as a prediction of a crash. We are moving past that assumption. This flow identifies specific, engineered targets for institutional liquidity extraction. We'll analyze macro cross-asset flows, then microscopic options chain anomalies. This synthesis separates reactive gambling from predictive institutional analysis. Bitcoin has transitioned into a strict range-bound distribution phase. It is currently acting as a locked vault. As Bitcoin stalls, Ethereum takes over as the beta expansion asset, drawing in speculative capital looking for movement. In this environment, Bitcoin is the passive anchor. Ethereum is the active battlefield. But Ethereum's volume is context-dependent. Rotation alone doesn't dictate direction. Rotation paired with a buildup of call options indicates a risk-on continuation. But rotation paired with put anomalies signals that the money moving into the asset is actually positioning for a drop. The current data confirms a defensive rotation. The capital entering Ethereum is buying protection, not just price exposure. This setup is a measurable precursor to short-term volatility expansion. Institutions use that volatility to mask their positions, allowing them to fill heavy downside hedges without alerting the broader market. The aggressive capital inflow we see is the engine providing the liquidity necessary to fill those short hedges. We can see this stalemate directly in the order book. There are currently 10 units of resistance for every 10 units of support. It is a state of perfect structural equilibrium. This balance paralyzes price. The market is waiting for a news catalyst or a liquidity trigger to force a move. In this range, the market frequently produces fake breakouts and violent sweeps back to the mean. To find the bias, we look at smart money polarity, a metric that weights aggressive market orders against passive limit order walls. On a scale of 1,000, directional aggression, the intensity of market buy orders, is high at 867. But structural defense, the weight of passive sell orders holding price down, is even higher at 921.
Because defense outweighs offense, the market is structurally capped. Institutions allow movement within the range, but strictly control the trend. Upside attempts face immediate absorption. This isn't a breakout, it's controlled volatility. To find where this controlled move is headed, we look at the localized options data. Within the Ethereum options chain, we find the highest conviction anomaly, a specific put contract at the 1920 strike. This strike has a relative score of 43.0. This means the volume here is 43 times higher than the historical baseline for this specific contract. This concentration indicates either a significant downside expectation or a massive portfolio hedge. This contract expires on April 26th. This near-term expiry reveals a tactical maneuver. This isn't a long-term macro view, it's a play for the current window. The sheer volume at 1920 turns this strike into a gamma magnet. Market makers must sell the underlying asset to hedge their risk, as price nears the strike, dragging the market toward the target. The 1920 put is a mathematical destination for capital extraction. When we combine rotation, structural defense, and the gamma magnet, we get a clear path for the price. The market state is neutral to bearish with a controlled downside bias. Phase 1 is an initial bounce or fake strength caused by the current structural equilibrium. Phase 2 is a sharp rejection at resistance as that 921 defense ceiling absorbs the buying pressure. Phase 3 is the drift toward the 1920 zone, fueled by the gravity of the put anomaly. This choreography traps retail liquidity on both sides before reaching the true institutional target. Execution in this environment requires aligning directly with these structural flows, rather than simply reacting to sudden price wicks. The strategy is to sell the bounce. You wait for false strength before entering puts. Entry requires a weak breakout on low volume and visible rejection wicks at the resistance ceiling. The target for closing is the $19-20 magnet zone, where the institutional flow is positioned to exit. We define invalidation just above key resistance. If Ethereum holds above that resistance, the defense has failed. Puts will suffer rapid data crush. If the 921 ceiling shatters, trapped shorts will be forced to cover, flipping the market into a gamma squeeze. Success in these markets depends on the systematic alignment of your execution with the institutional footprints in the data.